cost of capital. And to keep it very simple, I'll focus on what needs to be done. All right, so first thing that we do here is just change the color of the thing. So you have sources of capital, and that is debt is one source, equity is another source. In equity, there is internal equity, or called retained earnings, and then external equity called common equity. So what we go is now we go to this is the sin. This is one source of capital, and that has to be because bond is tax. There is a tax and after tax. So this is the after tax 1 minus T and RD, and then preferred is this one, and then is common equity is this one. All right. So, and this is weighted average cost of capital. That means you take into account various sources of capital, R sub D, R sub S, R sub P, and put them together as weighted average cost of capital. Now, if you are given, the whole idea here is to find out all these numbers. These are called weights, and this is also W sub D, W sub S, W sub C, all of them together they called capital structure. That means what percentage of debt is in your financing, what percentage of equity is in your financing, and what percentage of preferred is in your financing. This should be P rather than S. All right. So the capital structure. So where do you get R sub D? R sub D you get from YTM calculation, which you did before your midterm. R sub P is given to you, and then R sub S is done through various methods, and one of the method is basically let me take that thing out too, is CAPM, or there is another way you can do DCF approach, and the last one is that we say bond plus premium. You get the bond return and then you add some ad hoc premium to it, because stocks are more risky than bond. So when you are given the data, you can apply those ways. So now this is the capital structure. You have debt 48%, and preferred stock 2%, and common equity is 50%. So with that you have 100% here, right? And market value is exact same, 100%. And if you have a target capital structure, again it has to be 100%. So would we have to now calculate R sub D, we have to calculate R sub E, P, and R sub S, and keep that as very simple. Is to find out R sub D, you use your calculator and find out the R sub D is 5%. You have to multiply by 2 to get to 10%. So then after tax would be, you take the tax out 40%, then you get 6%. Now we have done one, and then for preferred stock, we say your dividend is $10 and price of preferred stock is 111.10, and that will give you an R sub P of 9%. So slowly we are going there. First we found out R sub D, YTM through financial calculator, then R sub P 9%. And then what we do afterwards is about cost of equity. To find out cost of equity, we will go and do 3 methods. One is CAPM methods, where we get all the inputs, and then for the other one is dividend yield plus capital gains, and then this is an ad hoc method. You get R sub D first and then add risk premium to it. So the first one is RF. You put in all the things that are supplied to you, you get 14.2%. Then you apply the DCF methods, and in here this is R sub S is dividend yield, and then capital gains, you get 13.8%. And finally you go and do that. You have R sub D as 10%, and you think R risk premium, that means this is the amount that is should be in excess of 10%. So you add them together to get 14%. So put them together in here, 14.2, 13.8, and 14. So range is 13.8 to 14.2. So maybe it is midpoint is 14%. So you now have all three returns. With that, you also understand that when you go to, after your retained earnings are exhausted, you float your stock, and flotation cost is about 15% of the proceeds. So this is the thing that is in addition. Without flotation cost, if flotation cost is 0, you are back to the same equation. R sub S is equal to D1 plus P sub 0 plus G. Now you adjust for flotation, you get that after flotation. Okay, you put those numbers in here, you get 15.4%. So what did you get? Let us collect so far. What did we get? We got R sub D as 10% through YTM methods. We got R sub P as 9% using the simple perpetuity equations, and we got common equity as 14% using three CAPM, DCF, and then bond premium approach, and then you take the midpoint. You put all of those together, you get weighted average cost of capital of 11.1. Okay, so tax rate will be given, all those capital structure will be given, that how much of debt you are going to use in financing, how much of preferred you are going to use in financing, how much of equity you are going to use in your financing. So this is then weighted average cost of capital. So there are other things that need to be considered. You see, if you get a weighted average cost of capital, we call that composite cost of capital, but you can have multiple divisions in your company, and with that divisions in company, in the corporation, this is your composite, this one is your composite, 10%. Okay, now one division which is doing very, very efficiently has a project which is 11%. Okay, but at this point in time, division, you see the weighted composite is here, right in here, 13%. So if your project has a 11% cost of capital, and your weighted average cost of capital is higher at 13%, and your composite is lower than the cost of capital, you say that you are going to reject project H, right? Because you are applying, you should reject project H, but you compare it with through the composite, which is lower than project H, which is 10%, but project H has a cost of capital of 11%, but you use the wrong weighted average cost of capital, which is 10%. On the other hand, a division with low weighted average cost of capital, you see this is the composite is right in here, it is at 10% right in here. the project has 9%. Applying the weighted average cost of capital of 10% to the project that is yielding 9%, you are going to reject this project. Why? Because you're comparing with the wrong composite. So even though you calculate a composite weighted average cost of capital, you should be careful. You should look at divisional cost of capital. So in this case, divisional cost of capital is 7%. Okay? And project is yielding 9%. You'll take project L. So you take, if you apply divisional cost of capital, you take project L. Applying divisional cost of capital. Right? And on the similar vein, you do the same thing with high cost of capital for a division. Now, divisional cost of capital is 13%. Okay? And your project is yielding 11%. Your composite is 10%. If you apply the composite, then you are going to just not, you're going to say, okay, take the project. But actually that has to be stopped. That cannot be taken. So if you apply divisional cost of capital here, so apply divisional cost of capital, then accept, then you reject project H. So you need to be careful. Just apply, getting weighted average cost of capital will not give you right decision. The right decision will be if you also be very discerning about divisional cost of capital. All right, folks. So in this chapter, your main focus should be how to calculate weighted average cost of capital and apply divisional cost of capital where it is given. If you have a question, as usual, let me know. Thank you.